Making the offer. To me, there's two approaches. There is the approach where you can use the sniper rifle, and that means you're just focusing on one good deal to focus on and try and obtain. And then there's the shotgun approach. And the shotgun approach is, when you're putting 10 offers out there at once. And that's fine, but if you're going to do that, please empathize with the real estate agent. We're now up to about 14 pages per offer, between Landlord and Terrorism Act stuff, buyer agency agreements, confirmations of cooperations, representation, the offer itself. It's 14 pages. So even if you're asking me to send 5 deals out there, that's 70 pages. See, I got math too. If you're asking me to send out 5 letters of intent, that's 5 pages. And that's a lot easier to do. And that way we can see which pieces of salami are sticking to the proverbial wall and focus on those deals moving forward. All right, but if you are going to use a shotgun approach, use the letters of intent. Otherwise, you're going to lose the real estate agents because they're not going to want to do all that paperwork. Okay, I'm going to get into some intangibles now. I'm sure I'm down to about, John, give me another 5 minutes. I always ask John for another 5 minutes. Give me another 5 minutes. Really quickly, property manager. I would say as far as the power team goes, that's even more important than the real estate agent long term. Because quite frankly, once we've got the deal done, we're still there from a consultation standpoint, but we are not there taking care of the building for you. We're focusing on finding the next deal, the next portfolio builder for you. It's the real estate agent that makes you realize the profits. And a good a good property manager will get you good profits. A great property manager will get you great profits. And I can tell you, as far as anybody in my power team, be them tradesmen, property managers, lawyers, accountants, the most difficult part of assembling that power team was the property managers, finding the right ones to not only refer to my client base, but even from myself and my own portfolio. It was very difficult. I'm happy to say that we've got about 3 different companies now that we're very comfortable recommending. Really quickly, smaller properties can be an issue simply because a property manager is going to be much more interested in managing the 20 unit rather than the duplex, simply because it's making them more money. Quickly on intangibles, this is not just about your cap rate. All right, I know you guys are crunching numbers and you're doing your math right now, but you've also got to look at the property and see how safe that investment is, right? What's the location like? What is the condition of the building like? There's a classic case of one of my clients buying a building, showed a 12% cap, got it no money down, 18 units in a part of town called Old Walkerville, which is our distillery district. On paper, a steal, beautiful. But what wasn't taken into account by and I didn't sell her this building. She did this herself. I picked her up as a client after, full disclaimer. But the boiler was on its last legs, and then it blew up on her in the middle of winter. The roof was shot. The windows were all rotted. The wiring was 60 amp, and half the piping was galvanized. And I can't think what else, but you're getting the idea. The building needed a lot of money poured into it. I don't have a problem if you're going to go after a property that needs some cosmetic upgrades, ceramic tile, painting walls. That stuff's cheap. But if you've got to do the big stuff like boilers and roofs and windows, and you're going to waste a lot of money quickly. If you're going to buy something that has a couple of those things on their last legs, then you've got to factor that into the deal. And again, a good real estate agent should be recognizing that and doing that for you. The hidden income stream is, I'll give you an example. If I've got a 10-unit building, I'm using a specific example in Windsor right now, but if I got a 10-unit building and I'm going to buy this thing at a 10% return, but I know I can also create an 11th unit, and it's also got 4 garages out back that aren't being used for anything, and the vendor just says, oh yeah, I'm storing my boat in there. Well, you might see a building with a 10% cap. I see a building with a 12% cap because even though the vendor hasn't added it to the cash flow analysis, you've got an extra $5,000 of income a year off of the garages, and you've got an extra $5,000 income a year off of the 11th unit that you can create. Well, $10,000, I don't know if you've been taught the 10 times rule yet, but that means that property is worth $100,000 more to me, equity-wise, than as advertised. Those are hidden income streams, and you will become much richer at this game and much better off when you have that creativity to see where you can make extra money on the property. Really quickly on dream killers is what I call them. I've got to be quick because I know I'm running out of time. Fear is a big one. I can tell you right now, the vast majority, without even seeing the class, and I can't see you at all. I wish I could. But at least half of you have been employed your entire business career. You're not necessarily business people. You haven't had to take calculated risks with your money ever. And now you're coming into this course, which is great, and you're getting the education, which is great. But now you're going to have to put your money on the line. You're taking calculated risks. By learning how to do due diligence, by learning how to identify things like cap rate, what you're doing is you're preparing yourself to minimize your risk. But at the end of the day, for the first time, you're going to take a risk with your money. So suck it up and buy something. Because quite frankly, at the end of the day, if you make a mistake and you buy the wrong property, at least you're learning. One of my most successful clients lost like 60 grand on a duplex in Toronto, but learned so much that they bounced back from it and made a significant amount of wealth and continue to. You got to take that first step. And quite frankly, I'm going to tell you the vast majority of your previous peers that have gone through the system, my happiest clients from those groups are the ones that started with something small when they were fresh and they hadn't owned one before. And student rental properties are great for that. Condos are great for that. In Windsor, we've got condos as cheap as $40,000. Start with a couple of those. Get your feet wet with the small stuff. Make your rookie mistakes with that smaller stuff. And what you're going to find is you're going to make mistakes that are going to cost you $100, $500, and you're going to learn. If you buy an apartment building right off the hop and you make those same mistakes, it's not a $100, $500 mistake now. It's a $1,000, $5,000 mistake. So what ends up happening is learning those mistakes costs a lot more money when you start bigger. And I really don't think, and this is my personal opinion, and John allows me to disclose it, but I really do think from experience and watching you guys grow, I would say start small first. You're going to see about 80 or 90% of your fear disappear. You're going to see 80 or 90% of your questions disappear. You're going to learn your rookie mistakes, and then you can grow from there. This isn't a race, and to me, that is the best way to start. All right, and I'm going to finish with this because I know I'm probably over my time, and John's probably smirking because he knows I'm always over my time. I like my own voice, unfortunately. The top 10 distinctions between the middle class and the wealthy upper class. And it's very simple. And these, if you basically write these down, you're doing yourself a great service. Millionaires think long-term. Middle class thinks short-term. And a great example of that is media. I don't look at the media. I'm not saying I'm a millionaire. The media, you've got to understand, gets you watching by creating fear. And the more scared they make you, the more you watch and the more advertising dollars they can sell. Millionaires aren't leaning on the local newspaper for their economic advice. They're leaning on economist reports. And they're accessible through the web. I subscribe to the Royal Bank of Canada's economy reports. So I already know that the economy is predicted to continue start growing again in 2010, slowly but surely. Right? To me, that's not a disastrous situation, and I'll continue to invest. And I like when people are scared. When people are scared and they're thinking short term and they're looking at the plant closing today, that's great because I'll make more money because I'm thinking 5 years from now, I'm thinking 10 years from now, and that's the way that you've got to think moving forward. Probably the biggest thing on here, and we've already talked about it, millionaires take risks. The middle class don't. And you're now getting into a situation where you're investing in real estate. You are taking calculated risks. Take them because this class is absolutely useless to you. And, you're making John and the boys happy. You're making them money by showing up, but you're not doing yourself any service. Get ready to suck up some fear and start investing and do it rationally with the tools that you're learning in this classroom. And finally, millionaires learn and grow. the middle class not so much. And by you showing up at this class, I give you congratulations, because you are taking that learning process that you need. I hope this has been of help. I believe Jean is going to give you a file copy of this presentation. There is an appendix at the end which has got a lot of research tools that I like using. It also includes my website. So my name is Rhys Trenhill. On behalf of my team at OntarioRCI.com, thank you for listening, and good luck.